Hi, Cindy Edwards here, and I am with Tim Arrowwood again from Preferred Rate Mortgage, and he's been doing a lot of educating us on different subjects, and we're picking a few of the subjects that we think are going to help you as well. And this one is the USDA loan and eligibility and everything, the map, everything that goes with it. And we're just really going to break it down for you and see that, you know what, it's a great product, but it's can be limiting at times. And there are other products that might be better for you or just as good with different rates and just you never
Mhm.
know. So you got to be able to look at it all and explore it all. So with that said, I am going to pass you over to Tim. Welcome, Tim.
Hello there. So Tim Arrowwood here, Preferred Rate Mortgage in Johnson City, Tennessee. So one of the Cindy and I, before we jumped on this call, we talked about a lot of different things, and I think that it would be helpful to just kind of give you a high level view on the USDA loan. It's a USDA rural development. And the big one is it's not used by farms, right? So that's the first thing. I used to get a lot of questions about that because, well, what is the USDA? I mean, they're USDA Prime. I mean, is this cuts of meat? What is it, right? So USDA is a program that would be considered a government program like FHA is and like VA is, and it creates a government-backed mortgage product. And so the big thing about the USDA is that it's 100% financing. Now you got to remember 100% financing doesn't mean no money out of pocket because you are going to have closing costs and things like that. But the USDA loan is fantastic. It's probably second only to the VA loan in terms of, it does have mortgage insurance, but it's a small mortgage insurance. But the rates are typically very good. The thing and early in my career, I used to do a lot of USDA loans, and it has just waned over time. And I thought about that as we prepared for this, and I was like, why? I wonder why that has happened. And I believe that part of it is that the USDA is a little bit limiting. You have to make enough money, right? Which is obviously you can't make too much, right? So, for example, the USDA has a maximum household income, but the big thing that's been a limiting for us is that the debt to income ratios that are used for the calculations are more conservative than they are for FHA, which FHA and also actually it's more conservative than conventional as well. And so if for example, if we're able to do on an FHA loan, which many times, not always, but many times FHA tends to be the product that is used for first-time home buyers or folks with very little money down. So that's kind of the competition, if there is such a thing for the on the USDA. It would so FHA will allow debt to income ratios sometimes up to like 55, 56%. Not that you should go that high, but you can. And sometimes there's reasons why, like maybe we're doing it. There's a couple and we can't use one of the couple, and so we're going to see, what's the maximum that one of the individuals can borrow. But it allows a higher debt to income ratio. And what I run into with USDA is that the limits are like 42%, right? So if you're comparing 42% debt to income ratio versus 54, 56, it really limits what you can do. And so I think that the reason for that, I think, is in our area, the pricing, I mean, in general, for houses have really since COVID have accelerated, right? Many times they've doubled in prices, and so the folks that were able to afford that USDA loan and have low debt to income ratios, they're just being squeezed. I think that's across the board, but I think that's a reason for that. The other reason is that USDA requires that the house be located in an eligible area, right? So it's designed for rural development. Well, it's supposed to be in rural areas, but what's the definition of rural? Somebody's got, and that's hard word for me to say, rural. But 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 there has to be a definition of what is rural. And so, USDA provides us a map that we can look at, and we can look at those things. But I think the big picture is that that it's a great program. It's just limiting, and so there's fewer folks that qualify for it, and there are some alternatives. And I can talk about those if you'd like.
So, would you say the closest alternative to the USDA loan, and not counting VA, because not
Mhm.
everyone can do
Right,
VA,
right.
but would you say that would be FHA?
Yes. So FHA is going to require 3.5% down, but there are some neat programs. We call it DPAs, or down payment assistance programs. So in the state of Tennessee, we have a government-backed one called THDA, Tennessee Housing Development Agency.
Mhm.
It has a piggyback loan that would allow you to borrow the 3.5%, or sometimes more than the 3.5%, to cover the down payment. I really like the THDA loan, but it has become a little bit more restrictive as well. You can't make too much money. And so you can't, it isn't limited by geography, but it is limited by it's limited by the maximum household income. Um,
I'm sorry, Tim, but is the maximum household income on THDA, is that going to be higher or lower than USDA?
Typically it's going to be lower. So what's worked with THDA is going to piggyback off of the guidelines for FHA. And so you're going to have, in some cases, so you might be able to do I'm sorry, THDA is probably going to have, the last time I did one, it's been 6 months or so, it was about a maximum of 45% debt to income ratio. Um, and sometimes you can go higher with certain restrictions, certain geographic areas. But the one I've been mostly doing lately is a I guess it would be the company that I work for has a down payment assistance program. There's no maximum household income. There's no geographic restrictions, and you have a high debt to income ratio. As long as we get what we call an approve eligible, we can do the loan. The rates are, I mean, they're a little bit more expensive, but I mean, we're not talking, oh, it's 2 percentage points higher. It might be an eighth of a point or a quarter of a point higher than what you might find for THDA or USDA. So the
And that one doesn't have a cap for how much you make,
that is
household
correct.
income?
That's correct.
Oh,
Yeah. So
that would be
no max,
good.
no max household
Yeah.
income. So it's been my go-to recently. Now if somebody fits in the other one, and but it's a subset of a subset, so that's what we end up working with. Um, and it's, in this case, it's an FHA loan that is a traditional FHA loan, but the down payment and any of that, the other monies come it's a it's a conventional loan with a 10-year amortization, and the interest rate is 2% higher than the FHA loan. So if the FHA loan is 6.5, the piggyback loan is 8.5, right? It's a 10-year loan, and what you're doing is, and you pay it separately. So it's like you're just able to literally borrow your down payment, instead
Okay.
of saving for it. You can, and I tell people to if you're going to pay anything extra, let's focus on paying down that piggyback loan, so that it is
Okay.
so that it
Okay.
is, you pay that off first. And now, and any of these loans, and I try to caution, my clients, is that, you're borrowing 100%, right? So if you do not intend to stay in this house for a long time, it may not be a good program for you, because if in a year from now, you go to Cindy and say, hey, I need to sell this. Something changed in my life. You don't have any equity, right?
Mhm.
So the money that you didn't bring to closing when you bought the house, you're going to have to bring that to closing to sell the house.
Valid.
That's
Yeah.
not a good conversation to have. But if you
No.
know it up front, and I tell a story about my daughter bought, it's probably been 8 years ago. She used THDA, and she bought a place in Johnson City. And I was a little concerned, right? Should she do this? Come to find out, the timing was fantastic. I looked like a hero, because she went from buying a place for, I think, 126. It's probably worth 300 now. So now I look like a
Wow.
hero, but it could have been if she had bought after COVID, right? In the last 2 years, there just hasn't been that much appreciation. Now, if you're going to live in the house, it doesn't matter, right? It's like having a car. I don't care if I'm upside down in the car in my payment. If I have no intention of selling it, I may not like the payment, but I'm okay. I just continue on until it's paid off. But that's where the problem comes with any of the 100% financing is that we run the risk of a life-changing event happens and I've got to sell, how are we going to do that?
Right.
Now, you can
Right.
rent it out. Cindy can help you, property manage, do all that stuff, to minimize the impact. But those are all things to consider.
Well, that's good. I mean, it sounds like an amazing loan with the
Yeah.
THDA to be able to borrow that money on top. And
Yeah.
you know what? I've done a lot of THDA loans in the past. I haven't done any in a long time. People just really
Right.
got away from them. And I haven't
Right.
done a lot of USDA either because people got away from them. Done a ton of FHA, and probably for all the reasons you're saying, but at the same time, I think it's really important for us to understand why that is and
Hmm.
why we're doing the FHA loans, even though there is another loan that might
Hmm. Right.
work for you.
Yeah.
But yeah,
And I
I
think
like
that,
it.
I mean, obviously we'd love to work with the client, but sometimes people will come to me and say, I want this loan. I'm like, okay, that's fine. We have those, but why? Let's talk about the why, because it may not be the best program for you, right?
Mhm.
Now, and it's actually pretty common. I like for people to come in educated, but sometimes they've had a family member, a parent, a sibling, somebody says, whatever you do, don't do this. Like, okay, well, I don't know where they're coming from, right? Because they just may have
Yeah.
had a bad experience. Like the big one is don't, whatever you do, don't pay that mortgage insurance. Like, I get it, right? Nobody wants to pay it, but it does give you the ability to do things that you would not be able to. And again, I think
Right.
about if my daughter had to save up 20% before she bought this house, she probably wouldn't have been able to save up in time to get it before COVID. So now she's saving up, she's tried to save up 20%, and then the goal keeps moving on her, right? And now she's got to save 20% of 300,000, right? And so she would never have been able to get in there. So anyway, would you like to?